Chapter 12 of the Income Tax Act 2025 sets strict, uncompromising limits on the physical cash moving through your business. The penalties for violating these limits are absolute. If you make an undocumented cash mistake, the fine is exactly equal to the transaction amount. A 50,000 rupee error costs you a 50,000 rupee penalty. To protect your operations, we are going to build a physical, step-by-step cash compliance protocol that you can deploy to your staff immediately. To follow along, grab a pen, a piece of paper, and the total gross turnover figure from your immediately preceding tax year. By completing this simple checklist, you will establish clear boundaries for your daily operations, ensuring your hard-earned revenue stays with you instead of being lost to an audit. Step 1. Write down Rule 1. There is an absolute ban on accepting or repaying any loan or deposit of 20,000 rupees or more in cash. Imagine your business needs quick liquidity, so you borrow 15,000 rupees in cash from a friend on Monday, and then borrow another 10,000 rupees from that same friend on Wednesday. This chart shows exactly how the aggregate trap works. Individually, those loans are under the limit, but Section 185 tracks the total unpaid balance from a single person. When Wednesday's loan stacks directly on top of Monday's, the aggregate balance hits 25,000 rupees, crossing the red 20,000 rupee threshold. The moment you cross that line, Section 450 activates. This 100% penalty drops down, matching your aggregated loan rupee for rupee. You now owe exactly 25,000 rupees in fines. Section 188 applies the exact same logic when it is time to repay that friend. Handing them 20,000 rupees or more in cash triggers another 100% penalty. To clear these balances legally, you must use an account payee check, a bank draft, or an electronic clearing system like NEFT or UPI. The only way to survive an audit under Section 185 is to treat multiple small loans from the same person as one continuous, cumulative balance. Next, write down Rule 2, the 2 lakh rupee ceiling for daily receipts. Rule 1, restricted borrowing. Rule 2, governed by Section 186, controls how you get paid for general business sales, and the threshold here is significantly higher. Let's look at this split-screen scenario. On the right, a customer tries to buy 3,50,000 rupees of goods using a massive stack of physical cash. Accepting that entire amount is an immediate violation of Section 186, resulting in a penalty equal to the full 3.5 lakhs. To legally save the sale, as shown on the left, you can accept up to 1,99,999 rupees in cash. You must then mandate a digital payment or an account payee check for the remaining balance. You cannot bypass this by splitting a single transaction into multiple smaller cash invoices. The law monitors the underlying event. Whether it is a single transaction or multiple transactions relating to one occasion from a person in a day, compliance requires capping the cash received per customer interaction, not per piece of paper. Let's shift our focus from individual transaction limits to your required business infrastructure. Reference that turnover figure you wrote down earlier. This progress bar illustrates Section 187. The moment your gross receipts or turnover from the immediately preceding tax year crosses the 50 crore mark, you are legally required to provide prescribed electronic payment facilities. If you hit this threshold and your digital payment systems are offline, this daily counter begins ticking. Under Section 452, you are hit with a 5,000 rupee penalty for every day the facility is not provided. It is a continuous, compounding fine. Write down Rule 3. Physically verify your hardware. Ensure your POS machines are operational and your UPI QR codes are scannable. For large-scale operations, maintaining a working digital payment infrastructure is a strict legal compliance metric. Finally, write down Rule 4. Identify legally protected cash channels to avoid turning away valid business. This infographic maps out the institutional exemptions. If you are accepting money from or repaying money to the government, a banking company, or a post office savings bank, the standard cash limits under Sections 185 and 188 do not apply. The agricultural sector also has distinct protections. For primary agricultural credit societies, the strict 20,000 rupee limit for accepting and repaying deposits is substituted with a much higher 2 lakh rupee threshold. Section 185 also ignores the 20,000 rupee loan limit entirely if both the payer and the receiver rely exclusively on agricultural income and neither has any income chargeable to tax. Understanding these exemptions allows you to maintain legitimate cash flow from protected sectors without fear of triggering penalties. Look at the 4 rules you just wrote down. You have successfully built a zero-penalty cash compliance protocol. To implement this, type the document out, print it, and tape it securely to your cash register. Train every staff member to verify these rules before accepting 20,000 rupees for a loan or 2 lakhs for a daily sale. If a violation does occur, Section 470 offers a reasonable cause defense, meaning penalties will not be imposed if you can prove a legitimate reason for the failure. However, the burden of proof rests entirely on your business. Fighting a retroactive legal battle is incredibly difficult. By following this checklist, you actively prevent violations at the point of transaction, keeping your operations compliant and your revenue entirely intact.